following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
All right, we are back with Bobby Iaccino. Bobby, good morning. How are you?
Good morning. How you doing, Jim?
Pretty good, man. Let's talk futures. We had quite a morning. We have a lot of stuff going on in the world. We have wars that might get worse. We have supply chain issues maybe rearing their ugly head again. What's going on with this in general, you think?
Yes, I guess it was bad timing for me to kind of smirk at wars going on. But when you look at the global supply chain, it is essentially healed. And when I say healed, it's back to where it was pre-COVID. Now, that is like saying that somebody who was probably 40, 50 pounds overweight and ended up 150 pounds overweight is back to only 40, 50 pounds overweight. Because the supply chain, we found out through COVID, was not healthy. And there's something else about it. You mentioned the wars and the geopolitical situation. There were also others that found out the supply chain wasn't healthy and have now seen sort of secondhand, we've seen firsthand, what can happen if you disrupt the supply chain. So yesterday, there was a news report, I believe it was out of Reuters, that said that Iran has said they will not close the Strait of Hormuz for now. Now, we know that the Iranian consulate in Turkey was attacked. There were some deaths there, and they've promised to retaliate against the West as a general monolith, right? And one of the ways they can do that is they have the proximity and the military ability to shut the Strait of Hormuz, to put a blockade there. And somewhere in the range of 60 to 70% of OPEC's oil supply flows through their exports. Now, the drop that we saw in crude oil yesterday had to do with Iran saying they weren't going to do that. Some of the spike we saw in crude oil a few days prior was because a lot of people were speculating that that's what they might do to harm the West. Now, we also saw the Houthi rebels hitting the Red Sea, shipping containers and ships. And that, again, was a supply chain vulnerability. Now, I was just watching the CEO, founder and CEO, can't remember his name. His first name was Nick, of Snap-on Tools. And it was interesting what he said. He said that right now there's a lot of talk about domesticating the supply chain. He said, and businesses haven't seen it yet. Now, that's something that we wouldn't know as market participants as to whether the political rhetoric, which generally results in very little action, was actually resulting in very little action again, right? That's something we kind of have to rely on hearsay. And that's the first I've heard that businesses are not seeing it yet. You maybe are seeing that in the NFIB Small Business Index, which hit an 11-year low yesterday. It was 89.4, down from 88.5. And for reference, that's a small business confidence index. And for reference, the average recession level of that index is 91. So 91.9 to be exact. So we're well below where we normally are at in a recession in an expanding economy. So that tells you that small businesses are not very positive and they're not necessarily participating. And that's important.
So Bobby,
yes.
Nicholas Pinchuk, I think is his name.
That's his name. Thank you.
Yeah.
Thank you.
And so this idea that tightening, creating, I would call it tighter supply chains. You know, we have yesterday, I think it was announced that Taiwanese chip making company is going to receive billions in incentives to expedite their construction of their Arizona facility.
Yeah. So one of the things that I think the Biden administration has done well, and it's not a political statement because I don't make those on shows like this. One of the things they've done well in their Chips and Jobs Act, which is only partially correctly named, was to partner with private companies like Taiwan Semiconductor. The best way and the fastest way to affect change in an economy is to partner with private business, not for the government to spend the money. We all remember the $50 hammer and the $200 toilet seat story from the 80s, right? Where the government doesn't spend money efficiently. So allocating money, $9 billion loan to Ford. Now, they dictated what that would be for, which would be for their electric vehicle plant. That may not necessarily be an efficient way to spend that money. But when they allocate money to private business, it does work much better than when the government spends it themselves. But it's not happening very quickly. And we're seeing that in the CPI numbers today.
Yeah. So, but just going back to TSMC,
yeah,
we're talking 11.6 billion. Now, why wouldn't that just be given to a domestic company to build this facility? Because of, why Taiwanese?
You're trying to get me political now.
Oh, sorry.
It kind of it kind of aligns the US with Taiwan, and that's a shot over the bow to China. That says, look, we support Taiwan and you need to realize their independence, maybe not publicly, but in the halls of power within the Chinese Communist Party, you need to realize that the US is partnering with Taiwan. And it kind of tells China passive aggressively, but still tells them nonetheless that we're committed to Taiwan's independence.
I thought you were going to say,
doing that with Taiwan Semiconductor and China takes over Taiwan, you've now done it with the Chinese Communist Party.
I got it. I thought you were going to say because they're really good at it.
Well, they are, but that's not why. That's not why.
Yeah. Okay. So, all right. So you mentioned CPI.
Yeah.
Just about every major bank's predictions were off by 0.1% or some small number, but it seems significant to the equity market.
Yeah. So let's look at it this way. I heard Tommy say that expectations were for a little bit higher CPI. And that is true, but only in one read. Okay. The expectations for the year-over-year inflation rate were for 3.4% from 3.2. Okay. Came in at 3.5. So Tommy's spot on in saying the expectations were for a stronger year-over-year headline, and they came out even stronger. But expectations for the core month-over-month and headline were lower. They were lower by 0.1%, and they came out unchanged at 0.4%, which is a beat. And it leaves the month-over-month growth, which is what affects the base effect of the year-over-year growth, right? We also saw the core inflation rate was expected to drop from 3.8, this is year-over-year, expected to drop from 3.8% to 3.7. It came out at 3.8. Here's a couple of things about a CPI. And I'm actually going to read from my phone because I'll make sure I'm saying the complete thing. I have a TV interview later today where they asked me if I had anything different about CPI. And this is what I wrote to them. Number one, the super core inflation, which the Fed has been touting ever since regular core inflation stopped dropping, is plus 4.8% year over year. Okay, now what's super core? I'm not reading this now. Super core is X food and energy and X housing, okay, X shelter, which a lot of people have been saying has been distorting the CPI figures. Well, the super core is X shelter, and it's up 4.8% year over year, okay? Number two, this is the third consecutive month of hotter than expected CPI numbers, which is a trend, not a one-off, not even a two-off. It's a trend, okay? Lastly, when you look at what's been going on with commodities, commodities are basically the foundation of goods inflation, which is the part of inflation, the part of the rate of change of inflation that's been dropping. And goods inflation has gone from negative to less negative and is now kind of, if you were to chart it, it's got kind of a rounding bottom going, right? And commodities in the form of copper, for example, everybody's talking about gold, of which I've been long gold since November 2022. So I'm glad it's doing what it's doing. But copper has outperformed gold, and gold miners have outperformed gold and copper miners have outperformed everything. So if goods inflation is turning back up, and it looks like they are, then to me, the Fed has lost control of the inflation narrative, because services inflation continues to drive higher. That also doesn't take into consideration something, and this may be too much in the weeds, Jimmy, and stop me if it is, but that doesn't include currency debasement. Now, we started the show talking about supply chain issues. Currency debasement is a driver of inflation that you don't really see in goods or services. Okay, it's kind of a supply chain thing. So, for example, if there's damaged cocoa plants in Africa, right, then there's less cocoa, and the currency you have, while not increasing domestically, is buying less cocoa. So it's a form of inflation, or I should say it drives price changes that are not driven by the Fed printing money, goods costs going up. It's just a supply chain thing. And right now, currency debasement has averaged 8% a year since about 2017. So if you add in 4% inflation to 8% currency debasement, you need 12% returns a year to break even. In terms of your, it's troubling. It's very troubling. So the June rate cut, to me, is off the table. It's gone. It doesn't exist anymore. There should be no possibility in the CME Fed Watch tool. I haven't looked at it, so I don't know if it's changed yet, but it should be gone. It should be off the table. We saw, what happened with gold. We talked about the NFIB, and that's what's happening in the Russell, because small businesses are not participating as much. And also gold should definitely have sold off, because the dollar spiked. The dollar in the aggregate is having its best day in a couple of weeks, at least, maybe even a couple of months. I didn't really compare, but the dollar is much stronger. We've got an ECB rate decision tomorrow where they're expected to be quite a bit more dovish than this CPI number was.
Yeah. So let's hold that thought for a second, because I'm thinking Euro FX for a minute. But the Fed Fund tool right now is saying 96% chance, 97% chance, no change in May, 81% chance, no change in June, 55.9%, no change in July, and then a 45% chance we're gonna have a cut in September.
Do they still have the December cut in there too?
And then one more for December, but it's only at 34.5. Now you have some outliers that are a little lower, but really there's a 30 in December. We're talking 34.5% will be between that 475 and 500, and then the 32% though we're going to be stuck at 5 to 5.25.
How much can I talk about this?
As much as you want.
People talk about Fed credibility, okay? And they say that the Fed cares about their credibility. We're going to find out if they do, in my opinion, because I think as a strategist, my job is to figure out what's going to happen and how that affects markets. As an amateur, untitled, non-diploma economist, okay, I think they shouldn't cut rates at all. In that same commentary that I read you a part of, I said they're now limited to 2 cuts maybe this year, and I still think they're going to do those 2 cuts. But I don't honestly know what the reason is. Okay, the reason to me, I guess if I had to pick a reason, is because the Fed has not ever been good at forecasting. They called the spike in inflation transitory, then they started fighting it with 75 basis point rate hikes. Well, that's not transitory. That's something you're worried about, right?
Yeah.
And now if they decide to cut rates in this environment where none of the data we are seeing is consistent with 2% inflation, they've got 2 choices. Either they accept a higher inflation level, which as of the last 2 Jerome Powell speeches, he said they're not going to do that. Okay, 2% is their target. Those are his words. Then you've got a problem cutting rates and having credibility. Okay.
But he also said, so Bobby, and maybe I didn't hear it correctly, and he didn't say it this blatantly, but he suggested that he doesn't know where our star is at this point.
Yeah, I wish they would stop talking about R star, and I wish they would get rid of the dot plots because the market priced to the dot plots plus. So you remember when they initially had those 7 rate cuts priced in, when the Fed initially verbally pivoted, they priced in 7 rate cuts in 2024. That was what, in late 2023? And I remember going, that's insane, 7 rate cuts in 2024. That's pricing in a really severe recession, which I did think we would get. I was in the camp that we would get a recession, okay? But we didn't. So I was wrong on that. But now when you talk about, R star to the neutral rate, when the economy is growing on fiscal policy, meaning government spending, and it is not constrained by Fed policy, R star is useless to me. To me, it's useless. So I think that's part of what Jerome Powell was trying to say. So, we spoke to Emma Muehlman yesterday, and she said to us, that podcast will be out on Monday. That's on our Futures Edge podcast. She said that the market prices to the dot plots, and the Fed says the minimum amount they can while they try to fight the fiscal policy, because they can't do anything about government spending. Nothing they can do about it. In the past, you even saw Fed governors. The first one was Greenspan. Bernanke did a little bit. Yellen didn't do it at all, where they actually, in their Humphrey Hawkins, well, we used to call it Humphrey Hawkins. I don't even know what it's called now. Semi-annual testimony, where the Fed would go before Congress and start kind of trying to tell them that they need to rein in spending. They don't even try to do that anymore.
Yeah, but is it a possibility to start talking about that? There's so many Fed speakers right now running around all the time. Goolsbee, I think, is today also. Is that a strategy by the Fed to start suggesting this is a problem in public?
I think the speakers are more important than Powell, because I think they're sort of like foot soldiers. Now, I have no inside information on this. This is one of those things that you theoretically can to go to a cocktail party and say Bob's nuts. He thinks Powell's sending these guys out. But I think Austin Goolsbee is going to be a big one today, because he is one who has said that he is, I'll leave this part out. He is one who has said very recently that he thinks rate cuts will still be appropriate. So has Bostic. He speaks tomorrow. Trying to think. Christopher Waller has said that, what's the rush? Kashkari has said, what's the rush? So you watch what these guys have said before and then see what they say now. So Goolsbee, let's see if he today, because we're going to get him today, let's see if he's still as dovish as he's been. Also, we get the FOMC minutes today. So what was that conversation like?
Yeah.
Was there any sort of mention of, we better be careful here? Because over the past 18 months, we've heard Powell and the rest of the Fed speakers, but Powell specifically say it's a bigger problem if we err on the side of not hiking enough. That's a bigger problem. Mm-hmm. So in other words, if they make a mistake by not hiking enough, it's harder to fix. So does that also apply to cutting too soon? It's really not the same thing, but it kind of is. So I think you're right to watch those Fed speakers, if that's what you were saying, Jim. I think it's what you were.
Yeah, I think they have a general script. There's a general script that, I'm sure they have their Slack meetings or their Zoom meetings, and they talk about these things. But you do see outliers. You do see folks speaking their mind, and you have kind of a division between bank presidents and appointed folks. So they might have a different opinion also, just because of the nature of what they see behind the scenes. You're running a bank, you're going to see it. You're going to have a different set of data points that you're looking at, that you're analyzing, and that you're strategizing over.
Yeah, and there's something I need to point out from an equity perspective. Okay, this is not, we're seeing equities drop today. We're seeing a little bit of a bid, as Tommy pointed out on the chart before I started. And, he said it was all buyers, and we were starting to climb up, and we're starting to do that. I mean, the Russell was down 3%. It's only down about 2.4 as I'm talking to you right now. And I wouldn't necessarily buy this, but I would buy the dip because an inflationary environment based on a strong economy is good for stocks. Okay. Stocks are an asset. And when things are inflating, prices are inflating, but so are asset prices. We always forget that when there's stronger inflation, there's also asset inflation, and stocks are assets. So that means your home prices are going up unless the Fed hikes rates. That means stocks are going up unless the Fed hikes rates. It means gold will probably go up unless the Fed hikes rates. We're getting a sell-off today and it's profit taking. I mentioned that I've owned gold since November 22nd. I lightened up a bit last week, but I still own a lot. So go ahead.
Yeah. So Bobby, I just before we leave Powell, he did say, and I wanted to get your interpretation of this, when he said the capacity of the economy moved up perhaps more than the output.
Sure. I mean, we're not seeing layoffs and we are seeing production increases. I mean, productivity is going up. So if you look, for example, GDP is unemployment plus productivity. That basically is what GDP is. Okay, so I should say employment gains. So if you see employment gains or wage gains somewhere in the 1.4 to 1.7, and you see productivity somewhere around 2%, let's say 1.82%, you're talking about let's call it a 2.8 to 3.5% GDP going forward. And that's why I brought it into the equity world, because if that's GDP, equities may drop here and there, but unless the Fed starts aggressively tightening, which no one, including me, thinks they'll do, you need to look for a place to, let me rephrase this. Stocks should be strong despite the occasional drop. Okay, it's going to be really hard to get stocks below some of those really strong support lines with inflation rising and with a reflating economy with stronger data. Unless all of a sudden we have a geopolitical event that matters. Strait of Hormuz would be one of those, by the way. Or we have a Fed that says, you know what, it's getting out of hand again. We need to slam on the brakes, which I don't think anyone's expecting, and I don't think they will do.
Yeah, so interesting. So let's talk about, let's go back to supply chain, right? So let's say the straits are closed for, unfortunately that, it happens. Mm-hmm. And is it a matter of supply chain just rerouting and reconfiguring, or does that dislocate traffic so bad it's going to be a long-term problem?
For crude oil, it dislocates it because some of the ports there don't have another option. Right? It's different than the Red Sea, right? Where you get into the Red Sea and it's like, hey, we might be attacked here. We got another place to go. The Strait of Hormuz takes oil out and refined products out of the Gulf. Yeah. Okay, so it's got nowhere to go. It's landlocked after that. So that's part of the problem with so crude oil is priced. This is how we price crude oil. It's the price plus pipe. Okay, the phrase plus pipe is used in crude oil in the energy world. Plus pipe means shipping costs. So if, for example, WTI is trading about 85.22 right now, it'd be 85.22 plus pipe. So what does that mean? Well, it means Canadian oil sands, they're going to have to drop the price in order to compete with crude oil that's being refined in the Gulf of Mexico, because shipping is cheaper than trucking and rail. So the plus pipe part is higher coming out of Canada than it is if it has to go by truck or rail. Okay, if it's not Canadian oil sands that are connected to a pipe. That's why the Keystone Pipeline was such a big deal when it got canceled, because pipe is cheaper than truck, pipe is cheaper than rail, pipe is cheaper than shipping, really, but it's slower than shipping. So when you close the Strait of Hormuz, that plus pipe part goes through the roof, because now those refineries theoretically have to truck it across parts of land that don't have roads, right? So it's really a problem if that happens.
So let's translate that to Europe as an example. Would this be a case where the U.S. would just simply export a bunch more crude to Europe, nat gas to Europe?
So when we stopped CapEx for shale, we lost our status as the marginal producer. People love that we're producing a record amount of oil. I wrote an article about this on our Substack a while back. I could repost it on my Twitter if somebody wants me to. But basically, you're talking best case scenario, 18 months in the US. More average is about 32 to 36 months from exploration, lease expiration to actually producing crude oil. Okay. We have not been spending money to find new wells. Okay. So we can't just pump more and export more. We pump full on because we're capitalists. So the second you have somebody that is, they drill a well, there's oil there. And again, shale wells, I mentioned this before, shale wells produce the bulk of their production in the beginning of their life, and they tail off very quickly. Okay, so tons of oil at first, then it just tails off. We don't have capacity because we're a capitalist country. And when companies find a new well, they pump. There's no, let's reserve it a little bit. They pump and they sell. So we're not able to just, hey, we've got new wells coming on, or we can, pump a little harder out of this well. That's not what happens here. OPEC is more traditional wells, and they can actually slow production, speed production up. And especially Saudi Arabia has spare capacity. The U.S. doesn't have that. So no.
But is there increased pressure to spend CapEx for upstream at $100 a barrel or $120 a barrel?
Yeah, there is, but it takes a long time. And if you have an administration that is not cooperating, EPA, oil leases, and we currently do have that, you're still talking about, at best, an 18-month lead time. So prices have to get near there. Prices are good now. Somebody like Diamondback Energy, FANG, I really like that company. They have a lower break even. So they're already pumping full, and they're trying to get new leases and some new CapEx out there. But when you have an administration that's kind of fighting fossil fuels, not so easy.
Okay, so if we have that, if Europe's, let's take this round circle back to Europe as our final comment. Let's say, we do have this problem with the Straits of Hormuz, and then Europe again is in a little bit of a bind for energy, perhaps. But at the same time, Lagarde's going to be probably more dovish this week than our hawkish folks. Is that going to appreciate the Euro FX?
No, it's not, because you're going to have a situation now, my opinion, where Christine Lagarde would have to be very hawkish, in my opinion, to help the euro medium term. Okay, short term, anything can happen. We all know that. But medium term, you're likely to have, given the way the inflation is going in the EU versus the US, you're likely to have a weaker euro for the foreseeable future, and crude oil won't have much of an effect on it at all, because it will, the stronger dollar, right, spikes energy prices in Europe, obviously, because they're priced in dollars. So it really is kind of all hands on deck, because your point is that it's going to bring inflation to the EU, but it's not going to do it in the next couple of meetings. It's going to be more of a slow and steady thing. It'll be interesting to me if Lagarde, we don't even have the straits closed yet. So if Lagarde were to mention geopolitics could change their trajectory, that would be different, right? That would be quite a bit different. But I don't expect to see that at tomorrow's meeting.
Got it. All right. Well, I appreciate that, Bobby. We're getting close to the end here. How do people find you?
Easiest way to find me is on X, formerly known as Twitter, it's Bob_Iaccino. I think my name's on the screen somewhere. I'm spelling it is just ridiculous. And then obviously we have the Futures Edge podcast, which is on every platform under the sun. But I also post the full show on X, so you can watch it there as well if you don't feel like downloading a podcast app. But pretty much all of them have free, they have free trials. Like Spotify does video now, and it's the free version where you can get our podcast. So it's pretty easy to get. Also, I'm going to be in Miami. If anyone's in the Miami area, I'm speaking Friday at the Money Show down there, the symposium, with Jim Bianco, Jim Iorio, Tracy Shukart, and then Charles Payne is moderating our discussion. So
Awesome. Well, Tracy was on our show a couple last week. She was awesome. So you guys are
She's
gonna have a great time. See if we can get Mike Burke to come down and say hi to you, because I think Mike lives pretty close to you.
Yeah, that'd be great. I'd love to see Mikey.
All right, all right. Well, Bobby, again, thanks again for coming, being here with us. Appreciate you.
Good to chat with you guys again.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.